Welcome back. In the last video we said that you can buy stocks either in the primary market or in the secondary markets. In this video we are going to discuss this topic further. Most businesses usually start with capital of the promoter or their relatives and friends. As the requirement of capital grows, it may become necessary for a promoter to source funds from a wider group of investors. This may be either because the existing investor cannot invest more money or because the promoter does not want to be over-dependent on a small group of people. Primary market is the market where debt or equity securities can be issued by businesses. This is subject to them meeting certain criteria. The business is known as the issuer of the security. The issuer receives funds from investors, which may be individuals or institutions. Since here the investor buys securities directly from the issuer, this market is called the primary market. Since the securities are issued for the first time in this market is also known as the new issue market. The process of issuing securities in primary market is also known as going public, as this is where the public gets the opportunity to buy these securities for the first time. In the primary market, sometimes institutional investors like private equity funds also sell their stake along with the promoter. A company's ability to raise funds through primary market depends on its performance in the past and also its expected performance in the future. Retail investors who may not have specialized knowledge or skills require protection against a possible default or against their rights getting diluted by the company. In order to provide this protection, the primary market securities are issued under the scrutiny of the regulator. Regulators ensure that the issuers have clearly defined obligations. Regulators also make sure honor commitments they make at the time of raising funds. All the securities issued in the primary market later get traded in the secondary market. These securities are listed on exchanges where any investor owning these securities can exit their investment as and when they see fit. Since securities get traded on the exchange, a business's operation essentially remains unaffected from this exchange of securities between various investors. Also, since exchanges require companies to regularly disclose key information, the investors can regularly evaluate their investment based on this information. A stock's price reflects this continuous evaluation by investors and also their expectation of performance of the business in the future. You might naturally ask, are all issues in the primary market open to the public, that is the retail investors? The answer is that not all primary market issues are open to the public. It is very common for companies in early stages of growth to issue equity capital to certain institutional investors only. These institutional investors may include venture funds and private equity investors. Only when the issuer does not choose any specific group of investors but instead offers his securities to anyone interested in buying a security, the issue is called a public issue. Here is the rough classification of various types of issues in primary market. These include the public issue, the private placement, which can either be a qualified institutional placement or a preferred placement. Finally, you have the rights and bonus issue. Let's briefly look at them one by one. Public issue is one where the securities are issued to members of public or anyone interested in buying the security. The public issue may be an initial public offer, also known as the IPO, or the issue may be a follow-on public offer, also known as the FPO. We will cover these terms in a bit. The next kind of issue is the private placement. In case of a private placement, securities are issued only to institutional investors. Private placements are of two types. One is the qualified institutional placement or the QIP. The other is preferential issue. Qualified institutional placement is a private placement made by a listed company to qualified institutional buyers like mutual funds or insurance funds. The issuers issue a prospectus to various investors and invite them to bid for the securities. The other kind of private placement is preferential issue. In this case, the securities are directly issued to an identified set of investors on preferential terms. These preferential terms may be offered to any person, including the promoters and employees. Lastly, you have the rights and bonus issue. In case of rights and bonus issue, the securities are issued to existing investors. If it is a rights issue, the investors are required to pay for the new securities. In case of bonus issue, the investors get additional shares without making any payment for the security. We will cover rights issue and bonus issue in greater detail in upcoming videos. Now that we have briefly understood the various types of issues in the primary market, in the next video we are going to look at IPO and FPO in greater detail.